Virtual Financial Team Prosperity Introduction and Overview to Annuities. Indexed annuity. An indexed annuity is a fixed annuity, which means your principal is 100% guaranteed. Any credited interest is locked in each and every year. Your money grows tax deferred. You can receive guaranteed income for life. You avoid the cost and delays of probate with immediate beneficiaries. You avoid paying upfront commissions for a fixed annuity. There are bonuses paid to attract new customers, up to 10%, sometimes even higher. And you have complete privacy with this vehicle and instrument. A fixed indexed annuity can benefit you by providing you with two things: potential growth and safety of principal and previous gains. So the potential to grow your money without the risks normally associated with investments like mutual funds, ETFs, variable annuities, stocks. But you also get the safety and protection similar to the other savings vehicles such as savings accounts, money markets, and CDs. So what we've essentially done is combine safety with potential growth. So you do have the growth potential, and you do have the safety of principal and previous gains locked into one type of investment vehicle instrument that can get you both growth potential as well as safety. The fixed indexed annuity basics. You participate in a portion of any period of gain in a market index, however it's indexed, whatever it's indexed to. If the index goes up, your money grows. However, you're protected from any period of loss. You get to sit out the bad years. You will never have a down year due to loss, and that's important. We look at simple concepts like compound interest, rule of 72. Rule of 72 does not work with negative numbers, so you eliminate losses from the investment strategy, put you on a more clear defined path to have stair-step growth to get you into an endpoint. And all of your gains of principal are locked in each year. They can never be lost due to market downturn, and all interest credits compound tax deferred. So let's look at an example of $100,000, 3 different illustrated scenarios, and all from a period of time of 1998 to 2011. First thing we want to look at is the light blue line. This is a minimum guaranteed contract value, so we do have some stair-step growth. In period of time, we've got about $146,000 and change. Now, option B, or illustration B, direct investment into the S&P 500, as represented by this red line. So after all of this market movement, this gyration, basically this roller coaster ride, we have made just a little bit over 7.5% on our money total over that time period, in point $107,000 and change. Now the third option is the annual monthly average, and that you can see we're doing two things. You've got the safety of principal, you've got decent market growth potential. So by combining both of those two things together, you've outpaced the other options, and you've outgrown them, and you've got in period of $171,000 and change. So returns, yes, they are important. Safety of principal, equally as important. When you combine those two things together, put yourself in a nice position to have that stair-step growth, to get to an end point where it actually provides a standard of living or an answer to whatever you were looking for. Warren Buffett. Warren Buffett always talks about the importance of how to grow investments, how to grow your money, and it really centers around a lot about not losing money. When you read any of his annual letters, when you hear any of his speeches, when you generally see quotes about Warren, they center around these type things. And there are 25 insightful investment sayings from legendary investor Warren Buffett, and the top 2 are by far his most important. Rule number 1, never lose money. And rule number 2, never forget rule number 1. Ernst & Young, the very real possibility of living to age 90 or 100, combined with the volatility of inflation and investment returns, means that the risk of outliving one's assets now is quite high. And when you look at a lot of AARP quotes, 60+% of the surveyed said they fear outliving their money more than they actually fear dying. So without additional guaranteed lifetime income streams, such as income provided by an annuity, Americans are at a high risk of outliving their financial assets and living their final years in poverty. these golden years, the standard of living that we expected during these years is not coming to fruition. You've got seniors that are going back to work, picking prescriptions over food. We need to learn from the financial failures and planning that we've seen from previous generations and go forward and map out a better, clearer solution to a brighter future for ourselves. Increasing number of homeless, and we just referenced this in the last page. If we don't have the money to keep up with our standard of living or to keep up any standard of living during these retirement years, it weighs. It weighs on communities, states, and a nation as a whole. And you can see the number, and this is over 10 years old, but the number of homeless people over 50 is increasing at an alarming rate, and they have limited resources for the support. So once again, by having financial planning that makes sense, that provides us with money for long periods of time, it has a huge positive ripple effect on not only ourselves and our family, but like we just talked about, communities, states, nation as a whole. Another thing that we need to discuss is why most people today don't know who to trust. We're coming out of the financial crisis 10 years ago that exposed widespread corruption within the banks as well as Wall Street firms. Fee-based registered investment advisors such as Bernie Madoff, Alan Stanford, they ran Ponzi schemes, and under SEC supervision, they stole billions from investors. On top of that, you've got fraud by Enron, Merrill Lynch, Tyco, WorldCom. There's a long list. The life insurance industry is strictly regulated and has not defaulted on an annuity client in over 200 years. That's important. Life insurance companies are well-funded, well-banked, and highly regulated. So once again, the life insurance industry is strictly regulated and has not defaulted on an annuity client in over 200 years. Well, this was in the heart of the financial crisis a little bit over 10 years ago. We had some bank failings. This is outside Indy Mac. Guess what? A lot of people lost a good amount of money that was over and beyond the FDIC insurance that would cover. And you can see for, Indy Mac right here, over 10,000 people, 10,000 innocent people lost over $1 billion. And that's over and beyond the FDIC limits when Indy Mac Bank failed in 2008. Assets held by life insurers back the company's life, annuity, and health liabilities. Accumulating these assets via the collection of premiums from policyholders and their earnings on investments provide the U.S. economy with very important source of investment capital. Life insurers held over $6 trillion in assets in 2013. Assets of U.S. life insurers rose by 7% during 2013. You compare that against the average FDIC reserve ratio of approximately 1.35%. Banks are not well funded, not well banked, are backed. Insurance companies have to be. So when you look at the safety of who you're dealing with, the financial strength, life insurance companies by far outpace any other options that you have to deal with. New York Times. The biggest risk in retirement is running out of money. We talked about this. An annuity can help guarantee that you allow to buy you and pick out where Social Security leaves off. These are two important factors because in previous times, previous generations were retiring with a pension, Social Security. Two things now that we face. Number one, pensions are a thing of the history. For the most part, the ones that are still around are massively underfunded, and for a large majority of the population of a certain age, Social Security might not be there at all, definitely won't be there in this form. So we need to take a reevaluation of where we are, what's expected, and what we can do to help ourselves gain a standard of living or avoid a standard of living that we either want to gain or that we want to not have to experience. There are also stockbrokers and financial planners that are standing in the way of a lot of annuity-based presentations and offerings. Once the money goes into an annuity, they can't earn commissions from trading on it anymore, and they may not be able to charge fees for managing it. Financial advisors have a charming term for this phenomenon, annuicide. You insure, the revenue dies, so most of them will not even entertain talking about it, and if you bring it up, they're going to try to talk you out of it. going to give you two examples of people who've used annuities effectively. First one is Ben Bernanke, a more recent example. He was the Federal Reserve Chairman who steered us during the financial collapse of 2008, one of the worst since the Great Depression. Bernanke's biggest assets were annuities, 500 to a million each. When you look at the other stuff that he had, listed no stocks or corporate bonds, and no liabilities were issued or were listed either. So when you look at this, someone who understands finance, who understands economy, who served as a Federal Reserve chairman during a very peculiar and particular time in American history, chose annuities to both grow his wealth and protect his wealth as well. Now, going back a little bit further in history, Babe Ruth used annuities to fund his retirement. And when you look at what happened in October of 23, when the Yankees won their first world championship, the Babe began to plan for his, still distant in years, but for his retirement. And when you look at this, he funded annuities over his playing years. And when Babe Ruth began collecting on his annuities in 1944, the total return to his estate will be almost double the amount of premiums which he paid. That's it. Have a good cry. Get it all out. Then we'll decide where to invest what's left of your money. When you experience losses, it steals two things, time and money. If we have a 50% loss, yes, we need 100% gain just to break back to even, but that 100% gain could represent the leg of a bull market that we're simply not participating in. So we want to participate in most of the market upside, be shielded from downside market risk, corrections, and bear markets. Indexed annuities. Would you like the potential to exceed traditional fixed rates? Coming out of this ultra low interest rate environment, people are looking for a better way to save and a better way to earn. Would you like to keep your principal and credited interest safe from market risk? Well, in a boom and bust cycle of the market, that's important these days. And what you're seeing over the past 20 years or so is the boom in the markets is greater and the bust in the markets is greater. So you want to make sure that you protect yourself because A, you want to avoid losses, but B, you definitely want to avoid losses the closer that you get towards retirement and needing that nest egg to start producing income streams for you. Can you benefit from tax deferral? Yes, most of us can. Would you like to access your money anytime through 10% penalty-free withdrawals? Remember, an annuity is a contract where your money is locked up for a period of time. However, you do have the ability in most of these to pull out up to 10% per year of the accumulated value without any withdrawal penalties. Now, if there was a year where you did not pull out 10%, you can pull out 20%. So either 10% or on the backs of a non-withdrawal year, be 20%. So you do have access to your money even though you're in the lockup period. Would you like guaranteed lifetime income? This is a big part of the answer for a lot of people's problems. Will I outlive my money? In a well-structured financial plan with vehicles and strategies like annuities, you can make sure that you do have lifetime income. If you're looking to return, if you're looking to save your previous gains, you're looking to take advantage of all these things that we've talked about, annuity could be a great option for you both now as well as we go into the future, the life cycle changes and more needs or issues or situations might arise.